There it is from the Federal Reserve, ladies and gentlemen. This right here is telling you from the Federal Reserve, all they're saying is they are pumping money into the market and they are planning to not touch interest rates, which was good for the market. They're not touching interest rates and they're pumping money into the market. I mean, there's nothing else to say about that. And they didn't touch interest rates. So they're not going to touch interest rates until inflation is over 2% and we have very low employment. Y'all hear that? If inflation hits over 2% and unemployment is low, that's when you can see the Federal Reserve is probably going to start to spike interest rates. The devil's in the details. So the pandemic is causing tremendous human and economical hardship across the United States and around the world. Following moderation in the pace of the recovery, indicators of the economical activity and employment have turned up recently. Although these sectors mostly adversely affected by the pandemic remain weak. So it's saying that they have indicators that the economical activity and employment has turned up recently, even though they're saying the places that was affected the most, like your airlines and travel, restaurants, they remain pretty weak. So what did they say here? Make sure I didn't lose my space. Inflation continues to run below 2%. Overall financial conditions remain accommodated, in part of reflecting policies measures to support the economy and the flow of credit to the United States households and businesses. So essentially right here, they're saying that inflation is still below 2%. Even though they're saying the economy is starting to pick up, they're looking at the areas that was hit the hardest, like the travel and restaurants. They're still below. And they're also saying that inflation is staying below 2%, which they want to have. The path of the economy will depend significantly on the course of the virus, including progress in the vaccination. The ongoing public health crisis continues to weigh in on economical activity. Employment and inflation are poised to considerably risk the U.S. economical outlook. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. Bingo. Here it is right here. The Federal Reserve's goal is to keep inflation at the 2% over the long run. So if inflation starts to get over 2%, you can see the Fed is saying they're going to probably step in. So they want to say we want to get the most people employed with inflation staying at 2%. Why are investors caring about inflation? Inflation affects your real returns. So what good is it you make 10% returns, but inflation goes up at 9%? So you made a 10% return, but your real return after inflation and taxes turns out to be 9%. So the higher inflation is, it affects investors. That's why they want to keep an eye on it, because they're looking at your real returns, right? With inflation running persistently below the long run goal, the committee will aim to achieve inflation moderation above 2% for some time, so that inflation averages 2% over time, and the long-term inflation expectation to remain anchored at 2%. So they want inflation to go a little bit over 2%. They want to anchor in at 2%. The committee expects to maintain this accommodation stance for monetary policies until these outcomes are achieved. The committee decided to keep the target range for the federal fund at 0 to 1.4. So from 0 to 2.5%, that's where they want to keep interest rates right now. That's where they're at, and that's where they're going to keep them. So right there, they're telling you we're not going to raise interest rates because inflation is not too high, and we feel like there's certain sectors that haven't rebounded completely. So, okay, 1.5%, and expects to maintain that target until market conditions raise. Blah, 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 blah. Okay. That's one thing. They saying, here's the sauce. They're keeping the rates down until they can get inflation to be at 2% and maintain 2%, also with max employment. So as you can see, unemployment numbers start to drop and you see inflation sit around 2%. That could be an indicator that the Federal Reserve is probably going to start to raise interest rates, which could not take down the stock market, but could cool off the stock market. So that's one thing to keep in mind. The second thing, here's another. They always say the devil is in the detail. Here it is. The Federal Reserve will continue to increase its holdings of Treasury securities at least $80 billion per month, and of an agency mortgage-backed securities of at least $40 billion per month until sustainable further progress has been made towards the committee's maximum employment and price stability goal. So when the Federal Reserve is saying, hey, we're buying Treasury securities of $80 billion per month, they're telling you that's their code word. They're pumping money into the market, right? When the Federal Reserve is just buying a bunch of U.S. Treasury bills, they're pumping money right into the market, ladies and gentlemen. Keep that. That's the sauce right there. The Federal Reserve is pumping up the market by putting $80 billion by buying Treasury bills every month, and they plan to do this until they can get the maximum employment and price stability goal. So they're going to do this until unemployment numbers kind of get back to a good pace. So these assets purchases help foster smooth market functionality and accommodation functional conditions, thereby supporting the flow of credit to houses and businesses. So, let's go ahead and finish it off. In assessing the appropriate stance of monetary policies, the committee will continue to monitor the implications of information that are coming in for the economical outlook. The committee will be prepared to adjust the stance of monetary policies as appropriate if risk emerges that could impede the attainability of the committee's goal. The committee assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, inflation expectations, and financial international developments. All right. Jerome Powell came out and gave a very good speech about that. The reason why you want to be tuned into this information, because this information is very important, because the market was lagging the whole day until he put out that until he said, hey, look, ladies and gentlemen, I'm not going to raise the interest rates, even though I know the economy is starting to pick back up. We have areas that's being hit the hardest that haven't been picked back up. And until those things happen, we're going to continue to have interest rates the same. So that's a big thing coming out of the Federal Reserve, right?